Welcome to Study Loop.
Recall that adverse selection is when people who have inherently higher risk seek out insurance. What is the effect of this? Well, remember that insurance is based on averages. In other words, they look at all of the people in a particular population and they say, okay, there are people who are very risky. There are people who have almost no risk. There are people in the middle. They develop a mathematical model that can give them the average risk, and that's how they develop premiums. But what if the vast majority of people who are inherently risky buy insurance? Well, that's going to severely strain the system. How exactly is that going to happen? Well, you're going to have a certain amount of money, let's say, that is paid in premiums. And if this system was actuarially fair, then the amount of payments should be roughly equal, right? If it's actuarially fair, it would be exactly equal, but in the real world, it should be roughly equal with some profit for the insurance company. But what is this based on? This is based on, again, the average person. But what if the average person is not who's primarily buying insurance? What if it's primarily risky people? You're going to have a huge amount of payments relative to premiums. And that is going to make it very, very difficult for the insurance market to operate because insurers now don't know how much to actually charge in premiums because they don't know the kind of people that are actually buying insurance.